Is Japan's economy surging and the Bank of Japan itching to change course after decades and decades and decades of rock bottom interest rates? Well, maybe not. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro, and we're going to unpick the tremendous Japanese GDP number that came out this week, why it was so huge, what it means, why the Bank of Japan isn't going to do anything about it, and why the yen might rally anyway for reasons entirely other. By the way, as we talk here, if you're watching this on YouTube, do drop some comments at the bottom. Do you think the yen's going to rally? Do you think it's going to keep falling? What do you think matters? The Fed, the Bank of Japan, the global economy? None of the above? Let's have a conversation and we'll loop it into future Macro Money shows. In the meantime, what we are going to look at here is this sense that indeed the yen has been weakening and it may actually be looking for a turn, but Japan's domestic economy is probably not going to have much to do with that reversal. Let's consider why. Here to begin and to sort of set the stage for the conversation is the annualized quarter-on-quarter GDP growth rate. This is real GDP, so adjusted for inflation. Annualized just means we take the quarter-on-quarter number for the second quarter in this case and project it out to say, well, if you grew at this rate for a year, what would that amount to being? What you have here is obviously a very impressive number at 6%, the highest, as you can see here, since we came down off those heady catch-up highs post-COVID. You can see that down spike of 27.9%. That's how quickly in annualized terms the economy was shrinking at the onset of the pandemic. Then, of course, a very sharp catch-up burst of growth as things started to reopen, 24.5%. We haven't seen a 6% or higher number since we got down from those highs. So this is certainly eye-catching, especially considering the expectation was for a 2.9% annualized rate. So this is more than half of what we thought we were going to get if you look at baseline expectations. So seemingly, this lines up very well with some of the conversation we've been having about the Bank of Japan maybe starting to look in a different direction. There's been a lot of speculation about this. The Bank of Japan has been on ultra loose policy for decades because of demographic changes. The population has been aging. In fact, recently the working age population has actually started to overtly shrink. That, of course, has meant that in Japan, you have more and more people that are past their most consumption-heavy years. They're getting older, and most consumption tends to happen earlier in life during household formation years. As the population gets older, there's less consumption. Consumption is the biggest driver of economic growth for most economies, certainly developed economies. And so as you get less consumption because of the demographic shift in the makeup of the population, you end up with structural decline in the pace of inflation, and so a structural decline in interest rates. Growth and inflation tend to go hand in hand. If growth is anemic because consumption is anemic, inflation is anemic. And so interest rates have to go down. The problem with inflation being anemic, of course, is that if you don't expect things to be significantly more expensive in the future than you do today, well, that's going to hurt your propensity to want to buy those things earlier versus later. That sense of urgency is just not going to be there. And so you get into a kind of doom loop on growth and end up staying anemic for a long period of time. People often talk about a lost decade in Japan. So we have seemingly here signs that things are coming to life at the same time that inflation in Japan, which we'll look at in just a moment, has increased well north of the BOJ target. It's currently up at 3.3% as of last reading. That's well above the 2% that the BOJ has been doggedly attempting to achieve for years and years. So why wouldn't the BOJ say, oh, well, good. This is starting to head in the right direction, finally. Maybe we should consider exiting some of our aggressive stimulus that we've employed to try to get inflation higher, to try to break this doom loop. And maybe it's time to even consider some rate hikes. Well, not so fast. Let's look at the makeup of this GDP number and go ahead and deflate that optimism in so doing. Because what we see here is the private sector actually was a net detractor from GDP growth. The public sector added a pittance at 0.1%. These are quarter-on-quarter numbers now, not annualized. So we're looking at contributions to a 1.5% quarterly increase in GDP. So just a plain old quarter-on-quarter rise, which, by the way, you can see is just as impressive as if we were to look at it in annualized terms. That's that red line there. And we see 1.8% of this rise is net exports. So the external sector. Now, how is it that we have a 1.8% rise in net exports, but only a 1.5% rise in GDP? Well, take the 1.8, subtract from it 0.4, and add in the public sector. What you end up with is 1.8 minus 0.3. And so you end up at 1.5. So this is not Japan's economy accelerating. This is not consumption, which has been the thing that's eroded the picture, as we've just discussed, because of demographics on growth for so long. This is not that coming back. This is external. In fact, when we look at the private sector, of that decline of 0.4%, 0.3% is a decline in outright household consumption. So good news, this is not for domestically driven growth, for domestically powered inflation. What is going on in the external sector that we got a 1.8% contribution from net exports? Well, we can see here exports did in fact rise. The year-on-year rise in exports in the second quarter spirited at 13.6%. But what really adds insult to injury here as we look at the weak consumption numbers is that imports fell even more. They fell 16.2% year on year. So domestic demand really looking weak here. Now, the way that the net exports contribution to GDP works is you take exports, which is goods going out, money coming in, to put it in simple terms. You sell things abroad then pays you for those things, and so money is coming in. Imports go the other way. Goods come in, money goes out. So to get a net contribution to GDP, what you do is you take exports and you subtract imports to get a sense of the net inflow or outflow, so the net contribution to at-home economic growth from the external sector. In this case, exports minus a negative import number two negatives make a positive, of course, if we recall our arithmetic, ends up giving us a very strongly positive net exports contribution to GDP. But under the hood, what we find is that at least on the import side, it speaks to the same anemic domestic demand that the consumption numbers show us. And that, of course, is not good news for sustainable growth. In fact, if we look at the way that Japan's economy has been behaving more recently in a more timely way, these are the latest PMI numbers. They run up to July. And we can see that already forward-looking indications of growth, more timely-looking indications, had already crested toward the end of the second quarter, and we're already on the decline. Services on the decline, manufacturing in contraction under that 50 boom-bust line that the PMI numbers oscillate around. 50 means no growth or contraction. Above 50 is growth. Below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. So what you find here is that the trend is actually already going the wrong way. Now, that is not to say that that jump in exports isn't a good thing. It almost certainly is. But what we don't find is domestically led, consumption-led growth, which is likely to produce consumption-led inflation. At home, sustainable. The kind of thing that would get the Bank of Japan to actually move on rates. What we see is primarily imported inflation. And indeed, if we start to break down what's gotten these CPI numbers so hot, we see it in spades. The biggest component here is food. Energy even is at this point a disinflationary force. Housing, small contribution. The goods side of the equation, small contribution, as is the services. The biggest part keeping this CPI number elevated seems to be food. And of course, Japan is an island. So it imports a ton of the things that it consumes. Now, if you consider that there is a global rise in food that's generally linked to soft commodities being easily the best performing part of the commodities complex over the past year. So global soft commodity prices are up. This is most critically sugar in recent months, although it seems to be easing back a bit. Some of the shortages out of India that folks were worried about are perhaps being offset by bumper crops in Brazil, the largest sugar producer. But nevertheless, here we are, still a large contribution, outsized one, from food. And of course, the precipitous decline in the yen hasn't helped. The purchasing power of Japanese consumers is that much lower for imported goods if the yen is falling. So, and the yen has fallen clearly. In fact, it's been falling since early 2021, largely because most global central banks went to go raise rates, and Japan did not, for the very reasons that we're talking about here. Because while there was inflation that was feeding onto itself and becoming entrenched in the US, in Europe, it is not something that's occurring in Japan. In Japan, what you have is primarily imported, as opposed to domestically driven. And so is not entirely sustainable in the mind of the Bank of Japan, and with good reason. Now, the key question here, of course, is, well, what about that rise in exports? That's good. And a weaker yen actually helps there. It makes Japanese exports more competitive on global markets because it's cheaper for foreign buyers to buy them at a time when the situation in China is more anemic. And so maybe there's a degree of substitution in some areas. There's, of course, not a perfect sync between what China and Japan contribute into the global supply chain, but there is at least some scope. So why would we not be excited about the situation on the export front? Why isn't that going to continue to grow Japanese GDP? Well, the problem is the global economy is slowing. As we've seen already over the past several sessions here on Macro Money, looking at global PMI numbers, we can see manufacturing has been in contraction territory all year when we look at the global averages. Services had a nice bump at the beginning of the year, largely around the spending down of pandemic-era savings, around the pent-up demand for services that was delayed around various pandemic closures. So where people were not going to restaurants, they've increasingly started to. We've seen a pickup in travel. We've seen a pickup in things like going to concerts and various other events. So as we've had more and more restrictions lifted and more normalization, there was a pickup in services that diverged from manufacturing. Well, now it seems to have crested and is coming back down. And those savings seem to have been spent. Stimulus leftovers spent. And so we've had the service sector slow, and that's been pulling down the overall economy. Well, what are the components contributing to that? We can see here that the main catalysts for global growth are basically three engines of demand: the US, China, and the Eurozone, which give or take average to about a fifth of the pie each. Now, it's actually much more than that because the remainder of that 43% rest of world tend to be vendors dependent on demand from the former three. So if you're Central Europe, you're very much dependent on Western Europe, the core of the Eurozone, for demand. If you're Australia, most of Southeast Asia, New Zealand, a giant swath of Africa, and at least some of Latin America, you're dependent on China. If you're Mexico, Canada, another big chunk of Latin America, another big chunk of Asia, then you're dependent on the US. And so these three economies amount to even more than the 57% straight line share that we see here. Because a lot of the 43% wouldn't be contributing were it not for the former three being healthy. And healthy they are not. Certainly not uniformly so. China can't get off the mat here, seemingly. Their recovery hasn't really picked up any momentum that's been lasting since they jettisoned COVID restrictions back in December. That economy is struggling and might well be not necessarily in recession in the classic sense, but given their historic growth rates and the growth rates for still a catch-up economy as relative to an already developed one, they might as well be in a recession-like environment, given how slow things are. The Eurozone, if it's not already in recession, then seems to be hanging on by a thread. The way this PMI numbers there showed the regional economy already contracted in July. That's after Germany, the largest economy in the region, contracted in the second quarter. So whatever weakness we saw in Germany seems to be spreading regionally. And we'll probably learn that the Eurozone is, in fact, already in recession as the data catches up. The pocket of strength, the last remaining bit, is the U.S. That's what's keeping growth still somewhat in the plus column. We just saw earlier this week some very encouraging retail sales numbers that suggest that indeed the U.S. consumer, which is the driver of U.S. economic growth, something like 3/4 of U.S. GDP is household consumption. These numbers suggest that part of it is doing well. 0.4% month on month expected for retail sales, and 0.7 is what we got. If we look at the trend year on year, that was a 3.2% year on year rise, which is something that is the strongest it's been since February of this year. You'll recall that's when U.S. economic data was so strong that Fed rate hike expectations actually started to flirt with a Fed funds rate at 6. It's not really looking at that anymore. But when it was, we ended up with such a spirited rise in yields that Silicon Valley Bank went under. Signature Bank went under. Stress started to spread all around the banking system. So this is the strongest economic performance since then, since the strength then that then gave us the kind of yield jump and crisis that we found. So this is certainly a very strong number. And as we look at this, it is encouraging for staving off global recession, but for the fact that these resilient U.S. consumers have the Fed painting a target on their back. Because this is precisely the part of disinflation that the Fed is struggling with and wants to remedy. Well, once again, look at the makeup of U.S. CPI, as we often do. We see that services amount to the biggest contributor at this point. Goods inflation has been almost totally squeezed out. Energy is a source for disinflation. Food, we said soft commodities have been doing better than most others. You can see it in spades here in the difference between energy and food. Food has been a positive contribution, but nowhere near the contribution that that services have given us. And of course, this is primarily a story about sticky wages. Most of the U.S. employment contingent is employed in services by a wide margin, about 7-3. And so what we end up with then, as we see these kinds of consumption numbers, is really a reflection of exactly the stickiness in the U.S. labor market that's keeping inflation elevated. We still have a shortage of just about 3.6 million workers. That's feeding into this inflationary stickiness and keeping wages elevated and undermining the Fed's efforts. So when they look at something like this, and we just heard this from minutes from the July FOMC meeting that were just published earlier today, this is what feeds the Fed's perception that they're going to need a rise in the unemployment rate if they are going to get inflation in hand and down to 2%. That the next leg of this disinflation is going to be much harder than the first, which took us down from 9.1 here to 3 as of June. It's already started to tick back up a bit in July. It might well continue to, unless the Fed really is prepared to hurt the economy. And we've heard from them again in the minutes today that this is exactly what the program is. That they expect that the only way to resolve this supply-demand imbalance that's been feeding inflation's supply-demand imbalance in the labor market is to hurt demand, because you're certainly not going to create more supply in short order. There doesn't seem to be any kind of appetite for a massive immigration overhaul. And even if you had one, that's not something you spool up quickly to close the very particular labor shortages where you have them with labor that you magically find to import from abroad. Doesn't quite work that way, and certainly not on a short timeline. So the way to essentially bridge this gap between supply and demand is to reduce demand, which means that when you see these kinds of strong retail sales numbers, the next thing that you probably have to think about is the Fed's not going to want to see a lot of that, because that speaks to exactly the issue that is bedeviling their efforts. So they might be quite a bit more hawkish than the market is anticipating. But of course, what that does is it kicks out the last leg holding up the global growth stool. So how supportive then of an environment for continued growth in Japanese exports are we looking at? Well, maybe not very supportive at all. And this is what brings us to why the yen might rally for no reasons having to do with the Bank of Japan pivoting, or GDP being strong, or inflation being north of 3% in Japan. As we can see here, the Japanese yen has really built up quite the strong inverse relationship with global yields. This is because, of course, the Bank of Japan did not join this tightening. It has not joined any tightening for decades. And so what the markets tend to do, both domestically in Japan and abroad as well, is investors go and they borrow in yen for next to nothing, and they then reinvest into higher yielding assets, be they stocks that pay a higher dividend, or currencies that pay a higher interest rate, or bonds that pay a higher rate, et cetera, et cetera. And what that does, since you're borrowing for next to nothing and paying next to no interest on that borrowing, the assets that you are then buying that with those borrowed funds that yield more end up generating a positive income stream. The problem is, if there is some sort of a global crisis, deleveraging, liquidation out of all of those positively yielding assets, a lot of these positions are unwound. And so what ends up happening is folks sell out of them and then have to get their yen back so that they can cover their borrowed yen loans. So they cash out of, let's say, U.S. bonds or U.S. equities. They end up with dollars. They have to use those dollars to buy back yen to cover their yen-denominated loans. So when there is some sort of a global crisis and markets fall, such as would be in a global recession if the Fed were to kick over the U.S. consumer, with no other offsetting factors in the Eurozone or China to pick up the slack, then you end up with a broad-based market rout, the kind of thing that gets the yen going higher. You also end up ostensibly with yields coming in, because as any kind of global recession gets worse, capital goes to the safety of bonds, and central banks have to invariably, when things get bad enough, start thinking about easing. So the yen might well rise here if these dynamics start to accumulate in the coming weeks. But it won't be because the Bank of Japan is doing anything different, most likely. It won't be because GDP in Japan continues to grow at a very aggressive rate, most likely. It'll be for actually the opposite reasons altogether. And that is macro money for today. Just a quick reminder, do drop a comment if you're watching this on YouTube. Let me know if you agree, disagree, if you think the yen is going to go up, it's going to go down, why not. and we'll happily incorporate that into our conversations going forward. Macro Money is here every day, Monday through Thursday, right after Overtime, which is a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we try to figure out what happened on a given day and maybe even unpack where things could be going next. I'm on with Chris again for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and commenting on Twitter. Yes, Twitter, at illustrative. Thank you very much for joining. See you tomorrow.